And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA CIB, proud sponsor of the ABSA Africa Financial Markets Index 2025. Good evening. I'm Stephen Grootes, 7 minutes after 6. Quite a busy day in a way. A lot of people, I think, watching and waiting and in some ways hoping for some kind of end to the trade war between China and the US. And we saw, of course, the US President Donald Trump and the Chinese President Xi Jinping speaking together in South Korea. And yes, Trump said that out of 10, they got, the meeting was at 12, but really it kind of looks like nothing big has been sorted out. Maybe that's the best we can hope for, actually, and let them continue to do the negotiations and the chat and all of the rest behind the scenes. But you would maybe like, when you've got these meetings, when you've got handshakes, maybe something bigger will come out of it. I think there might be a little bit of disappointment about it. A strong update, I thought, from Dis-Chem. We'll speak to their CEO, Roy Moraes, in just a moment. Looking forward to that conversation. The Public Investment Corporation, they've been talking about the re-industrialisation of South Africa. How much money is needed? Not as much as you would think necessarily, but what they're suggesting is that there could really be a big change. But they're quite optimistic. They talk about South Africa's strong industrial base. My first thought was, but aren't we about to lose our only sort of long steels business? Isn't that about to go? So, I thought that was a bit strange. We'll put that to them in a few moments from now. Also, of course, look at the issue around gold and very interesting comments from the World Gold Council about demand for gold higher than it's ever been, which I thought was interesting. And we kind of see that. And Siphumelele Zondi before 7 o'clock, the first layoffs that we're seeing as a result of AI. I thought all of that was really important. Good to hear from you tonight. 011 883 0702 021 446 0567 and voice notes on 072 702 1702.
The Money Show
with Stephen Grootes, live on 92.7 and 106 FM, streaming on the Prime Media Plus app
and DSTV channel 856.
I don't know if it's just that I've got a little bit older, but I think this is actually a reflection on how the world has changed. When Walmart first bought into South Africa, and they did it through buying a part of Massmart and then eventually buying the whole thing, it was a big deal. Everybody talked about it. We talked about the change in retail. Now, Walmart opening Walmart-branded stores. They confirmed today Clearwater Mall in Roodepoort will be the first one. And my reaction is kind of meh. I think that's a reflection of how retail has changed. There was a time when it would actually be quite difficult to get certain things. And by a time, 10 years ago, you would go to the United States or wherever and see things that you wouldn't really see here. They'll be quite difficult to get. You'd buy them somewhere else because they were cheaper. Amazon came along. Takealot came along. That's a big factor, I think, and changed that. And as it happens, I was actually in a Walmart in Arkansas back in September, not very long ago. And my first thought when I walked in, literally my first sense of it, when you sort of see the light and the smell, was, oh, I'm in a big Macro. That's really all I'm in. And the pricing is different and the books are very different. And I don't think Macro sells that many guns. But otherwise, that's kind of it. It just smelt and sounded like a Macro. So I don't know how much excitement there really is around Walmart coming to South Africa. A few years ago, maybe there would have been a lot. Not so much now. I'll tell you this, though. They say they are going to bring in some products that you don't see here very often. My understanding is that is going to be American confectionery, by which I mean sweets and chocolates, which means that there's another whole long list of things for your kids to get addicted to.
702. Stephen is on The Money Show.
6 to 8 p.m.
Dis-Chem confirming it's hiking its dividend by 9% for the 6 months to the end of August. Group revenue is up 8.7%, also investing a bit more in its life insurance business, and also what it calls ex-Bigley Labs. That's essentially their operation to improve their customer experience. Roy Moraes is the CEO at the Dis-Chem Group. Roy, good to talk to you again. Good evening. You've got a lot more revenue coming into your business. Are you able to tell if this is from new customers or are the same customers spending more money when they're in your stores?
Evening, Stephen. So the honest answer is it's a combination of both. So as a function of our new stores, we obviously get access to new customers as we extend our network. But at the same time, we do see our loyalty basket growing, which by implication means that the same customers are spending a little more in our stores, and specifically our ecosystem, which is something that we're very focused on. So, how do we get consumer spending across more than just is a physical store?
I mean, I presume you can almost plot on a graph in advance. You open a new store in a new place, and you can start to see how sales tick up, and some customers will just use that store because they've used previous stores before, and some will be new.
Yes, you can. So, I mean, there's a maturity profile or maturity curve that's actually really associated with how we capture scripts more than it is just normal customer foot traffic that comes with a new store. And then you quickly distinguish, to your point, customers that are moving from other stores or customers that are kind of engaging with the brand for the first time.
Your retail expenses increased by nearly 12%, and that's quite a significant figure. What are you spending that money on?
So core retail outside of the investment that we made in Life and X-Bigly Labs, which is our innovation hub, that we launched in December, was actually muted at just over 9% against total income at 10%, which meant core retail delivered on the back of positive operating leverage around 25% profitability growth. But I mean, we've always, and you kind of alluded to in your last segment, for all intents and purposes, retail is effectively becoming commoditized. If you think about the globalization that's happening, it's coming down to price points. South African consumers are super value conscious. And I guess when you start to think about that and how we think about our role is the way that you formulate kind of your strategic ambitions needs to be around how you deliver healthcare products and services, which are, fundamentally more sticky than traditional retail or general merchandise.
I mean, X-Bigly, your labs, what are you expecting to get for the money that you're investing? Is it just information about customers, which you're then able to leverage, or is there something deeper than that? And I realize that, data is the new gold.
So I mean, data is one of the things that is owned by X-Bigly Labs. X-Bigly Labs is certainly not just the data heart. So the reality is, if you are going to change a retail machine the size of ours, that does north of 35 billion rand in revenue, for example, and the way that it executes, you actually need to give innovation priority. Someone needs to live and breathe innovation. It can't be something that someone else does, in addition to running a store or in addition to running finance or in addition to running, a general kind of support system for the group. And that was the idea behind X-Bigly Labs. So it's really got two ambitions. The one is, how does it improve the customer experience? And then how does it improve metrically the way that we do traditional retail? So that could be anything from reimagining the way that a scripting process is done. If you think about it, I mean, you've been around long enough to know that the scripting process, for example, hasn't changed for 2 or 3 decades. You engage with the same kind of pharmacist, the same kind of capturing happens, and it's a very expensive cost to serve. So how do you reimagine that with like a different approach to process design and take out costs so you can pass on value to consumers? That's really the function of X-Bigly Labs.
Your main focus at the moment, I suppose, is still your Better Rewards, your rewards program. You spoke to us when it launched. How's take-up been?
So honestly, and I feel very proud to say, it's been incredible. We're obviously only 10 days into the program or 9 days into the program, but delivering above our expectation on all metrics. So that would have been volume growth that we're seeing from participating Better Reward brands, the acquisition of new loyalty customers, that people that have not engaged with the brand is up on a daily basis around 250%. And I think just anecdotally, which is also something important to kind of ingest and listen to, the feedback that we've received from the market around the level of discounts that they're seeing and kind of the loyalty that buys, for lack of a better term, is something that was at the core of the design philosophy for Better Rewards. How do we ensure that more of South Africa's healthcare basket, more of the consumer healthcare basket is spent within our ecosystem, and that's the kind of feedback that we're getting. So as it stands, very early on, but super positive.
I mean, these reward schemes, we know how important they are to groups like yours. Your main competitor has one that's very popular as well. Do you think there's anything that makes your scheme stand out, that offers value that others don't? Because everybody has them, but they're kind of a competition in their own right now.
Yeah, so I think the way that we think about rewards is fundamentally different to how a traditional retailer thinks about it, and it was born out of X-Bigly Labs, so a different approach to rewards. I mean, the way that we think about rewards is it's effectively an always-on promotional mechanism, right? And the difference in our program is that it's 140 of South Africa's most loved brands, so 10,000 articles or 10,000 products in our stores. These are the things that have been selected analytically that are shopped the most frequently in South Africa by the most number of people. So they are stable in the consumer basket. And they're always on promotion in South African retail. Our reward program then heavily discounts the promotion price. So on top of promotion, you get an always on 10% base discount for no fee. And then depending on how you engage with our ecosystem, so if you shop our pharmacy and you invest in preventative healthcare, or you buy your chronic medication, that 10% goes to 15%. And, with our arrangement with Capitec, if you pay with a Capitec card, it goes to 20%. So if you think about something commoditized like a nappy, that price point exists everywhere on promotion across South Africa. You're now getting access to something that is a commoditized product at 20% lower. So it is fundamentally different to what exists in South African retail today.
Roy Moraes, thanks very much indeed. The CEO at the Dis-Chem Group, 17 minutes after 6.
7:02.
7:02.
Stephen is on X.
At Stephen Grootes.
The Public Investment Corporation putting out quite a bullish case, I thought, for investing money in the re-industrialisation of South Africa, a research paper which has been co-written with Oxford University. The paper says that if investment in industrialisation was doubled over the next 5 years, it would create 250,000 jobs. Geoffrey Nolting is the senior economist at the PIC and co-author of the paper. Geoffrey, good evening. If we were to double investment in industrialization, which sectors, where would we need to spend the money? Which sectors would actually be the places that would generate these jobs?
Good evening, Stephen, to you and your listeners. So I think the rationale of the paper was to look at how we can use particularly institutional capital, such as the PIC. And to answer your question, the main sectors where we really believe is a lot of opportunity is in automotive, as well as agriculture and mining, particularly mining beneficiation.
I'm a bit surprised to hear automotive because, China has too much car making capacity. Aren't we in a situation where you would end up having to compete with someone that has to shut down half of their electric car manufacturing capacity at the moment?
Yeah, I think more of a long-term getting through the current global business cycle, there's certainly opportunities there. I think from South Africa, we're uniquely positioned from a critical minerals positioning. We obviously are competing globally in a globally decarbonisation world. And I think South Africa has really set itself up as a destination for green capital. We've seen that recently with the current EU deal. And I think if we can focus on, reindustrializing our economy, I think we can, anchor battery and hydrogen supply chains both locally and then get that extended to global supply chains.
Would it require a bit more than just investment, but maybe some policy shifts as well? I don't want to remind you, Geoffrey, but the mining industry has a complaint or two about the way government manages that sector.
Absolutely. So I think the real problem is where we are is why we find ourselves in the current situation is, we have dealt with very outdated policy, and that certainly needs quite a bit of work. But also, we had massive issues with our energy infrastructure, and we are starting to see that really recuperate. Yes, I think maybe the policy certainly needs a bit more work and fine-tuning, but we have seen a number of political parties putting out their economic plans, and they all seem very keen on, increased private participation. The key message from our paper is really that, we don't need more government, but rather that South Africa was sitting on this latent capacity in these sectors, and we believe that can really unlock differentiated risk-adjusted returns. I think there's really a huge mispricing where South Africa is reforming from we believe, a very strong base, and I think that now's the time to invest.
So the reforms we see from Operation Vulindlela, electricity, all of those things you think are now starting to have an impact. And in fact, if you wanted to invest, this would be the moment because you get the best outcome over time.
Well, I mean, we're already seeing the huge benefits of the success of Operation Vulindlela. Roughly about 80% of those programs are either completed or are on track. They've made huge inroads, particularly in the financial sector recently. We've just come off the grey list, but also, I mean, keeping the lights on. And I think South Africa is really trending in the right direction. I think there's a huge inappropriate risk perception of South Africa that we're just some frontier economy when in reality, we've got very credible institutions, an independent central bank, we've got strong rules of law and a credible fiscal policy. Well, we'll see on the 12th of November. But really what we think is that, we aren't rebuilding from scratch. We've got a very strong base. And if we can get, as the PIC, we've got, over 3 trillion rands worth of assets under management, which, equates to about 40% of GDP. What we can do is we can really de-risk a lot of the early stage sectors, that commercial banks and maybe foreign investors are a little bit hesitant to invest in. But we really believe that the time is now, and, we can use our assets, to really signal, what kind of industrial policy that we're going for.
You say that we have a strong or an excellent industrial base. Isn't there an argument to say we need the investment now? I made the argument earlier that, ArcelorMittal wants to shut down, that in fact our excellent industrial base in the way you describe it might be at risk. If we don't move now, it'll get less excellent.
Well, excellent. I think it's more like the level where we're sitting at now is we don't have to build everything from new. We have a lot of existing infrastructure. And now, I guess, now sort of the country's at a crossroads where we need to make decisive decisions to, attract capital and get the economy going again.
Thank you very much indeed. Geoffrey Nolting, a senior economist at the PIC, co-author of that research paper. Fascinating research, also done in conjunction with Oxford University. 23 minutes after 6.
The Money Show.
The Markets.
Viv Govinder's portfolio manager at Rand Swiss. Viv, good evening. There seems to be a bit of a sort of muted reaction to this meeting between Trump and Xi. There was a bit of expectation around maybe there'll be a trade deal, and yes, things are a little better, but I suppose there's no certainty on anything.
Yeah, look, we don't know for certain what's going to happen here, but I do think a deal is likely to happen. Trump likes to make these deals and show his brilliance as a negotiator, to illustrate, he's the only guy that's able to make these deals, even though often the deal that we get in the end of the day is not much better than, what would have been possible without the drama at the start. That being said, I do think that, longer term, there is obviously serious fundamental differences between the U.S. and China in terms of what they want in the world, and not just about token things like, for instance, Taiwan, but about fundamental things about who gets to run the world economy, about who gets to basically decide the rules of global trade and so on. The U.S. obviously has been the dominant power for such a long time, has gotten used to being the number one. That the Chinese basically rising up is going to face a lot of resistance from that. And I think even though we might have a deal here, I don't think we're going to see normalized relations with the U.S. and China. It's because the U.S. can't afford for China to trade normally with the rest of the world, especially with things like artificial intelligence, etc.
And China's probably getting better and better at the trade game. They're just learning more tools, as we've seen with rare earths. The U.S. Federal Reserve last night, so yes, an interest rate cut. Pretty much almost everyone expected that. A bit of a warning from Powell, though, that there might not be another one this year.
Yeah, look, I do think that the Fed has to be cautious. We are seeing inflation in the U.S., even though it came slightly lower than expected, still at about 3% CPI number. That is well above what the hope for level is. At the same time, yes, we are seeing also signs that, unemployment is probably going to have a bit of a spike. We've seen again, with regards to AI, we saw, Amazon come out and fire, quite a number of people, and maybe there's the total number twice as much as the initial thing, about 30,000 people or so in total. There's also been a leaked report about Amazon looking at not having as many as 600,000 people on their payroll by 2032 as might otherwise have been the case. And I think also we are seeing other signs out there that there's some various weaknesses in the U.S. economy at the moment. But like I said, the Fed doesn't know what's happening, unfortunately, and not much better than we do. And that means that they are going to be very cautious about trying to do anything around, that's too aggressive, just because they just don't know what the actual long-term impact is going to be like.
And at the same time, Trump again yesterday, and I think Scott Percent today, are putting pressure on them to cut more. That's not going to make it any easier.
No, it's definitely not. I mean, look, the thing is that, ever since we got rid of the gold standard, the only thing that keeps any kind of currency in the world at any stable level is the credibility of that Reserve Bank. There's nothing back in the US dollar besides the Federal Reserve's backing. There's nothing back in the South African rand besides the Reserve Bank's backing. And if we stop believing in the Federal Reserve or the Reserve Bank and the power that they have to control spending and to basically, keep things in order, or keep the economy basically ticking on at the right speed, not overheating and so on, I think that's going to be quite negative for any currency going forward, even the US dollar.
Some tech earnings out, some of them not as good as maybe had been hoped for.
Yeah, the good, the bad, the ugly is how I think we term it. The good is, Alphabet / Google. The bad is Microsoft, and the ugly is Meta. And I think that's what the market's reacting. We had like a 4-5% move up for Google. Microsoft about 2% down, but Meta has fallen quite significantly. I do think that, this is a case of, obviously all these companies have done really well in the last little while, but Meta, I think, has been a bit of a laggard. Mark Zuckerberg has been incredibly aggressive on AI without much, success. And I think the one key point of that, he had a person in charge, Jan LeCun, one of the godfathers of AI. He's put a new person in charge, Alexander Wang, effectively, a young, hip guy who's basically, very talented, very gifted. But maybe is acting in a very, impulsive way in some ways. Because the one thing they did recently was fire a whole bunch of people from their AI division to, streamline it, make it more efficient. And all I could see on social media networks that are following AI is every single AI company is offering these guys jobs. If you got layered by Meta's AI division, you would just be snapped up by every single other AI company out there, showing that maybe this was this idea. But yeah, I do think Meta's, foray to AI, the aggressiveness that they're doing, as well as the lack of, I think, leadership, and showing, distinguishing leadership in the particular area, is kind of harming the company at the moment.
Viv Govender, thanks so much. Portfolio Manager at Rand Swiss. Really appreciate the time. Just gone 6:30.
WhatsApp Stephen
on 072
702
1702.
22 minutes to 7. Well, I was making the point earlier that something has changed in retail. Walmart is coming, but okay, so what? I think seems to be the reaction. I say that's because 10, 12 years ago, 15 years ago, when they first sort of came, you would expect to see new things you couldn't get before. Now, with the way that retail has moved, you just don't see that. Voice notes coming through on the whole issue of Walmart tonight.
Hey, Cape Talk. This is Alvin from Cape Town. Just a funny anecdote, a trip that my wife and I took to Mexico about 5 years ago, and we were staying with Mexican hosts, and we brought a whole bunch of gifts. And on the first day, we were walking along down in Mexico City, and we saw Walmart and headed on inside. Same thing, with much enthusiasm for the lovely products we would find. And what should we find? But as we walked through the main door, not 10,000 stacks of pallets of Amarilla, which rendered pretty much the rest of our trip and all the different hosts we were staying with. Our gifts were largely ignored and frowned upon when we described to them the wonderful Amarilla fruit and the wonders of elephants eating these wonderful fruit in South Africa, and how rare this gift was, when every darn shop we walked into, every Walmart presented us with the same huge display of Amarilla. So yes, indeed, I think it's nothing that you can't get anywhere else in this globalized economy that we live in. Take care. I don't think it's going to push the dial in any way, shape or form.
Yeah, thank you for that. It is actually, it's impossible now. If you're going from South Africa, what do you take that is South African? In some places, biltong's just going to get you into trouble. And also it's food and it's meat and da-da-da-da-da. What else do you take? Does anyone know? Do you take something gold from Eswatini? That'll probably get you into trouble. I don't know what you take, frankly. Maybe you've got a good idea, actually. If you're going to a foreign place, be it Beijing, Lagos, Sydney, what would you take that is uniquely South African? World Cup staying here, by the way.
The Money Show with Stephen Grootes is brought to you by ABSA CIB, proud sponsor of the ABSA Africa Financial Markets Index 2025.
Well, more suggestions coming through about what you would take to another country as a gift, what you would take to basically show South Africa.
Karabo from Pimville. What I will take that is uniquely South African, and what I will take abroad is a vuvuzela. Take a vuvuzela.
Of course.
Vuvuzela is uniquely South African. And I would take Impepo. It's an incense, an African incense. Impepo. I will take it to China. It's uniquely South African. Thanks, John. Lovely show always.
Hello, Stephen. What about Mrs. Ball's chutney? This is Craig from Johannesburg's Northcliffe.
Thank you. I suppose we can add to that Omar Rusks or something. But yeah, great suggestions of Vuvuzela. How could I have not thought of that?
702 with Stephen Grootes.
Email him on stephen@702.co.za.
The World Gold Council saying that the demand for gold in the third quarter of the year was the highest on record and driven primarily by investment demand. Joe Cavatoni is the market strategist at the World Gold Council. Joe, good day. I do appreciate the time. Gold prices have been higher in the third quarter than ever before. We've talked before about the factors behind this. Is there a sense of FOMO as well? Is gold now at the point where people are buying it just because everybody else is buying it?
Well, Stephen, thanks for having me back. And I have to say that within the last 3 weeks, there's definitely been a lot of momentum pushing the gold price. The volatility levels are higher. And you could definitely give a little bit of that push well beyond 4,000 to a little bit of FOMO. But under all of it is a fundamental case for portfolio resilience and central bank functional shifting structurally their reserve requirements, and that's why gold is continuing to have very strong performance.
Gold is now at record highs, which means doing what the central banks are doing is suddenly a lot more expensive. And yet, I mean, are they still buying as much gold as they were despite these very high prices?
So it's a good question. The pace with which they've been buying has slowed a bit. They have healthy levels of consumption, but we're tracking at about 3/4 of what we've seen in previous years. So the third quarter has definitely seen a pickup. And the last 3 years, we've seen record flows of over 1,000 tons each year. And we're tracking at about 630 tons year to date. So we'll probably come in less than where we've seen it. But remember, this is a 16-year trend. And these levels are well above what we've seen over that 16 years. So they're still very active, and we see a lot more opportunity for the emerging market central banks to continue to bring gold into their reserve portfolio.
And a weakening dollar, I imagine, along with several other factors that are still present, and particularly geopolitics and everything else, it just means that desire by central banks is likely to be present for quite some time, almost no matter how expensive gold gets.
I think that's right. I think what you're finding are central banks looking at, like you've said, geopolitical issues, trade tensions, questions around the U.S.'s ambitions or desires to reset the global trade environment, the strength and or weakness that comes along with the dollar-based asset performance. But don't also forget large markets like China and large markets in the emerging market sense are looking also at their homegrown challenges around their own inflation concerns and their own currency concerns. So there's definitely global implications that they could use gold and diversify into it, but also homegrown concerns that they're managing it with as well.
What's happening in jewellery? Obviously, gold for jewellery has, been a human tray for thousands of years. Is this sort of gold price having an impact on jewellery trends at all?
And that's absolutely the right way to think about it and what the data is telling us. This gold market for jewelry is definitely an emerging market, consumer market, China and India being the largest. And these higher prices making jewelry expensive makes it harder for people to obtain. So we're definitely seeing a slowdown. It's still very meaningful in terms of the above ground stocks as well as the actual levels of consumption, but you're seeing levels of 20 to 25% declines in the average level of gold consumed in jewelry in places like China and India. Higher prices, harder to obtain, slower for people to accumulate them. They may even be shifting away from gold to silver or something at a little bit more of a price point that's affordable.
I do wonder about that. And gold bars and coins, you say investment in gold bars and coins in the quarter was up 17%. A lot of demand there.
So again, at the heart of what we're seeing is this idea globally. Asia, the US, Europe in third quarter, all looking at portfolio resilience. So bars and coins, physical demand, as well as exchange traded funds, really driving a lot of what the consumption's looking like over the quarter. Record flows in ETFs, record flows in these other markets as well. This is really an interesting time, and it's actually all at the heart of it, looking at portfolio resilience.
I'm obviously never going to ask you what do you think the gold price will be, but we have seen some predictions that seemed like fantasy 2 years ago. The only thing I think it's safe to say is that unless something changes dramatically in the world, we're likely to see gold at sort of 4,000 for quite some time to come, despite the fact that a year ago that seemed incredible.
You know, we were talking about it a year ago as something very aspirational, very exciting to see if it could get to that point. I think risk and uncertainty, the way the geopolitical landscape is playing out, it's going to keep demand well outpacing supply. Supply is only coming online at almost 3% per annum, and we're looking at double-digit growth in terms of the overall volumes of dollars being spent on gold and, 3, 5, 7% increases in the overall tonnage. So you're really looking at a pace that's going to keep that price supported. Again, we're going to see some volatility over the course of the next couple of months. We're coming into year end, some FOMO. People might be taking profits off the table, might be rebalancing. But the overall structural direction for gold remains very strong. Investment in central banks at the heart of that push.
Joe Cavatoni, thanks so much. Good to talk again. Market strategist at the World Gold Council, 8 minutes to 7.
WhatsApp Stephen
On 072
702
1702.
More voice notes. What would you take to another country to show you're South African?
This is Selma of Roodepoort. Whenever my father-in-law came over from England, he always wanted to buy some local things that he liked. And one of that was biltong. His daughter loved that. And also, once when he came over here, he took a vuvuzela back home. And, of course, whenever it was Father's Day or his birthday or Christmas, he loved sending him these amagurula liqueurs. Thanks for a lovely show. Bye.
Thanks very much indeed. Interesting what we choose. So far, it's meat, it's alcohol, and it's noise.
The Money Show. Tech Thursday.
Well, it does seem now that we're seeing the first signs that people will lose jobs because of artificial intelligence. Amazon cutting 14,000 jobs, saying they'll eventually cut 30,000. Our tech expert, Siphumelele Zondi, joins us now. Siphumelele, good evening. Is it definitely AI that's leading to this? I mean, can we say that for sure?
Hello, Stephen. And yes, it actually is definitely AI that's leading to this, because a lot of things that used to be done physically, manually, are now being automated. But also, there was a lot of experimentation as well, especially in the beginning stages of AI. And as companies discover that certain things are not working as well anymore, it's interesting that AI as well, and some of that development might shut down, and that leads to losses of jobs in spaces where there were hires in the beginning stages.
I mean, obviously this is very difficult, but we were told, and we've been told in the past, that actually AI will lead to new jobs. I mean, isn't that sort of one of the benefits that we're told will come, that when you have a big change like this, it leads to new industries and things?
Well, it does lead to new industries, but at the same time, it seems like the initial stages are leading to losses. And what might actually end up happening is that there will be losses now until people are retrained, because it's not clear the direction that AI is taking and will eventually take. So it's not clear what jobs are even needed in artificial intelligence. We do know that the issues of data centers that are all over the world, and someone does need to oversee the running of those data centers, especially when there are a few faults and the humans might need to sort of like get in there and fix a few things. But we are going through a stage right now where I think the industry is trying to figure out what's needed and realizing that what was needed may not be needed anymore. And it's actually across very many industries. I even think about an industry like, for example, delivery. as we are buying a lot of stuff from home and as it's being delivered. But a lot of that is being automated now. You don't have people manning which orders are coming through anymore. You have a machine determining that, hey, Stephen clicked on a button somewhere. That button needs that, and it needs to communicate in that particular manner. So you don't really need a human there anymore.
There are some suggestions that, in fact, 150,000 tech jobs have been cut this year already. Do we know if there are other jobs for those people?
Well, that's the interesting part, because it's not clear where those jobs will be. Google has said that they will be cutting jobs, but what they're doing is to first is to allow people to figure out if there are spaces within the organization where they will fit in and where their skills can be pivoted to as well. Because as we're going through this period, it does feel like some people might actually not get employment as easily as they thought they would get employment in the past.
It seems to me that the first sort of people to go are the people in the tech jobs. And that's where AI is taking jobs now, not so much in other sectors yet.
It's across the place, because when you think about it, for example, if you're in HR and you find that your company had multiple people doing an HR job, and you find that there are now automated systems that can do what people could do in the past. So it's not necessarily a core technology, but it's because of technology, new AI technologies being introduced, that people will then start be losing jobs. So it's not necessarily core tech jobs, but it's jobs that are being lost because of technology. And yes, the technology industry is the first to have these big layoffs.
It wasn't very long ago that we all got very excited that at some government schools you could study coding. And, now it would seem that whole push to get people into the tech sector may have been a waste of time.
Well, that's interesting as well, because even coding itself, and I would think that South Africa probably got into it quite late, when you'd find that a lot of those skills 20 years ago were being outsourced from elsewhere in the world. I think of India, for example, and we started to have that conversation a bit too late, because what's happening now, especially with coding, is that there is automation moving into that space as well. So yes, it was a conversation that happened, but is it a conversation that needs to continue? Coders will still be needed, but will they be needed in the high volumes that we thought they'd be needed in, let's say, 4 years ago? In all likeliness, not. And so we might not necessarily need those big volumes and to need to train people at a bigger scale as South Africa was planning 3 years ago, for example.
Siphumelele Zondi, thanks very much indeed. Really do appreciate it, our tech expert. Interesting to see how this plays out. Impossible to predict what happens next. We have seen when big things like this happen. Think of the inventing of printing, for example. At first, people who would hand copy books lost their jobs. But look at what happened to the economy after that. You kind of hope that maybe these people losing their jobs, as difficult as that is for them, may be the start of something actually going the other way. Very hard to know. Good evening, you're with The Money Show. It's 7 o'clock.
The Money Show with Stephen Grootes is brought to you by ABSA CIB, proud sponsor of the ABSA Africa Financial Markets Index 2025.
And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
6 minutes after 7, good evening. Glad you're with us for the second hour. Plenty to come. We will be talking about jewelry. You heard the conversation earlier with the World Gold Council, a suggestion that, in fact, because the price of gold is so high, people are looking for other things, moving away from gold when it comes to jewelry. And you can just see how this is going to go. For some people, the mark that we're really rich, and if I'm really worth it, he'll do this for me, well, then you're going to spend the money on gold. For others, it'll be, no, I'm just going to find something else. I'm going to use silver, maybe even some platinum, who knows, maybe some white gold, and sort of use that instead for jewelry. But I think we are going to see a subtle change. I mean, the price of gold is just so high. We'll talk about that in just a moment. Also, we'll speak to the CEO of the company Resolute Education, Rajesh Pusunguli. The company that they've created really is amazing. It's essentially about helping people study using computers to do that, and essentially doing it through play. It's a very clever system. They actually won a big award not very long ago, in fact, at the Future Trust Summit last year. So we'll talk a little bit about that as well. And then don't forget, the investment school tonight, global diversification and today's markets. Vincent Anthony Raja will be in. You know the number, 011 883 0702 021 446 0567, and voice notes, of course, as well on 072 702 1702.
WhatsApp Stephen
On 072
702
1702.
Well, still a couple of suggestions coming through about what you would take if you were going to another country. And Stephen saying, salute. Thank you, Stephen. A peppermint crisp in Northern Europe. They were surprised when I brought that out. Stephen says he's from Wellington. I'm presuming Wellington, South Africa, in the Western Cape more than anyone else. Tom Sankar says, isn't it ironic that computer scientists that studied AI are the ones losing jobs? There is an irony there. It does happen sometimes when you see revolutionary change. The people in the sector are the ones that lose it first. I did think that was interesting. I don't know if you saw this today. SARS, this was in Fin24. They've been involved in this long-running battle with a person called Roy Malega, over 188 million rand. And essentially the claim that they've made is that Malaya imported 30 tons of tobacco, and then the tobacco disappeared. You know where it's gone. I mean, it seems pretty obvious to me. It must have. I can't think of anywhere else. It must have gone to the illicit industry. And so SARS basically have been chasing him for the money. And it seems that they eventually got it. Took a long time to get the judgment, by the way. Not sure why. But SARS, I just get a sense you hear more and more about SARS at the moment, and I don't think that that's by accident. I think that we're going to hear a lot more around enforcement. They want to sort of show that they're able to get more money in. We saw yesterday they beat the estimate for the fiscal 6-month period by 18 billion rand. I'll be interested in your experiences of SARS, though, if you're bringing things into the country, if you're working in the business space, what your experience of SARS has been there. Voice notes, please, on 072 702 1702, 10 after 7.
The Money Show
with Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app
and DSTV channel 856.
An interesting collection of jewelry on sale recently, and Status & Co. holding a fine jewelry sale. It includes our own Browns brand, along with companies like Cartier and Tiffany & Co. And we have rarely seen, when companies like Strauss do this and they put together a big exhibition, you really start to see trends in jewelry. Debbie Hathaway is a watches and jewelry writer. Debbie, good evening. To put together a sale like this, I imagine it's actually quite difficult. You need the right mixture of things. You need things that are attractive, and it must be quite revealing around what the trends are.
Absolutely, yes. Thank you. Good evening, everyone. I spoke to Kim Goller about this. She's the jewelry specialist at Strauss & Co. And they focus on fine jewelry when they're putting their auctions together. So they might be handmade by goldsmiths in the 1970s, or they could be manufactured in Italy 5 years ago. So they theme the auctions according to whatever they decide at the time, and they include a diverse range of luxury jewels. So if a Van Cleef & Arpels or a Cartier piece are a good fit, they'll include those. But equally, if a piece from South Africa's Browns or Elegant Jewelers works well with the theme, then they'll also consign those for the sale.
Can you, when you're designing jewelry, is there anything distinctive about, South African or Italian jewelry? I'm not a visual person, so I can't really imagine how someone would do that, and I sort of doubt that that's the case.
Well, the Italians would dispute that. Made in Italy is a huge brand, and the Italian leaders in the industry are particularly passionate about heritage and provenance, and their goldsmithing is arguably top in the world. So when it comes to Italian jewelry, you'd certainly be looking for handmade. Handmade is a huge plus. But when it comes to local, Browns is actually expanding. Kim was telling me that they're looking at Australia, but they're already beyond the borders in Dubai and London. So it's important for Strauss to promote beautiful South African jewelry creations, especially given their large international client base and their status as the leading auction house in Africa.
How do you make a name in this business? I mean, you obviously need to produce something that is distinctive. You need to produce something of a very high quality. You need to pay attention to many factors. And I imagine if you sort of look at the names, most of these houses, if I can call them that, have been going for a long time.
Absolutely. I saw something earlier today on social media where somebody was bemoaning the fact that there's, fashion jewelry has almost devalued the market in the sense that cheaper items have been sold, sort of gold-plated, flaking jewelry that just sort of gives the industry a bad name. So people, particularly collectors, are looking for signed pieces from the big brands, like the ones that I mentioned earlier, Cartier, Bulgari, Van Cleef, Piaget, those kinds, because they know that there's going to be potentially rarity, especially with the bespoke pieces. Craftsmanship is guaranteed. Heritage is there. Browns has been going for a long time. So it's certainly not easy. I think it takes grit, it takes determination. Obviously, your design factors have got to be there. And then traceability is a big thing now. So people are looking, especially the younger collectors, they want to know exactly where the gold and the gems have come from. They want to know that it's been responsibly mined. And brands who are doing the right thing in terms of sustainable sourcing are getting more support.
If you're Strauss and you're putting together a collection like this, I presume there's some big names you absolutely have to have, and you have to get the mix quite right. You have to include enough of the big names for people to be interested.
Yes, I suppose you could argue for that. Kim makes a good point in that jewelry is really no different from art. So, what appeals to one buyer might be less desirable than another. And if you look at the recent sale that closed on Monday night, incidentally, there were 128 lots offered, and they sold almost 80% for over 7 million rand. And those weren't all brand names. A diamond tennis necklace by Brown sold for 50,000 rand over its maximum estimate for 350,000. The pieces that they had by Fopé, which is one of the big Italian names, as well as Bulgari and Cartier, all sold within their estimate range. But one of the top lots was a 5.5 carat diamond solitaire, estimated between 300 and 400,000 rand, and that sold for 570,000. So it doesn't always have to be a big name. Discerning collectors, people know what they're looking for. They know, and of course, auction houses like Strauss do their homework and they make sure that everything is verified and authentic. So pieces that are not necessarily signed can fetch high prices like that.
And Debbie, a very high gold price at the moment. We spoke earlier to the World Gold Council. They suggested that globally people were moving away from working in gold, that basically the jewelry trend was changing simply because of the price. Are we seeing that here?
I can't comment on the South African market, but I write a lot about watches as well. And, the stainless steel watches are the biggest segment. And I suppose if brands are wanting to encourage people to start buying, they might go for lower value, but people who really want to invest in jewelry want to wear their pieces. So 9 times out of 10, they're going to go for gold, even if they start at a 14 carat. You can start from there, but 18 carat is ideally where you want to be.
Debbie Hathaway, really good to talk to you. Thank you very much indeed. Really appreciate the insights. The watches and jewelry writer on The Money Show.
The Money Show. Small business focus.
Well, one of the smallish firms, I say ish because I suspect they won't be that way for long, that's made a big impact in the last couple of years is called Resolute Education. They've been helping coding, robotics, stuff that I don't always understand, to basically help bridge that gap between school and universities. And in fact, last year at the Future Trust Summit, they won $1 million for their business. Rajesh Pusangili is the CEO at Resolute Education. Rajesh, good evening. Thanks so much for coming in.
Good evening, Stephen. Excited to be here.
So your company was first just you and one other person, a real person, not an AI person. You obviously had a background in IT. What made you think of this idea?
Yeah, so I actually dropped IT in grade 10, took history, because I was like, which is what I thought. I ended up in electronic engineering, and I think I realized how much I hated that field until I got to final year, and I got to build this really cool project, and I got it to work. But during my university years, I fell in love with education. I tutored a lot of kids, and then I thought I'm going to go change the world by becoming a teacher at a public school. So I went to go become a teacher, and that's where I really realized how tough our education system is to change. And being a tutor is one side of it. So teaching maths and traditional subjects like science is always interesting, but technology is moving so fast. And I started asking myself the question is, how are we going to bring these new age subjects into schools where kids are actually starting to learn these concepts? And so the idea of coding and robotics came through. So I partnered up with my co-founder, Gareth, who studied electronic engineering with me. And we started this company in under 2019, 2020, and it's been going well.
How would you describe the service that you actually provide? I mean, what you're doing is you're helping people learn. I have teenage children, and there's sometimes you can come across something, it was the same for me, and you just think, this is not that hard, but I just can't learn it.
Yeah, I think the most critical skill, like you said with your teenagers, you want them to learn, but I think I would phrase it as we want the ability to give the kids the ability to think. I think that's kind of our slogan, is even in the day of AI where everything's going to be automated, the true thing that we can really pass our learners on is how do we get them the ability to think, right? So we came up with that slogan, and think really does stand for like tinker, hacking, being inquisitive, being able to network, and being a lifelong learner, which is knowledge. And so these subjects like coding and robotics really helps kids how to problem solve, because it doesn't matter how far we go civilization and how technologically advanced we are, that ability to think and problem solve is pretty evergreen, and that's what we want to instill in our kids.
I remember someone describing it once as what you do when you get a new cell phone. You know, the first thing you do is you play with it. Try and change the screen, and you do this. I mean, and that is something that's innate. That's what we all do. I mean, that's the basis of toys. That's the basis of a human being. Is actually, I've got a mug in front of me, and I can unscrew it. Done that now. Now I'm going to spill water. You play with it.
Yeah, that's it. That's the fun part of the subject. So when you look at some of the traditional subjects in schools, it's very theoretical. Kids just are passive learning elements in there, and they listen to the concepts, and that's all that it is, right? And coding and robotics is part of this new wave of technology-driven subjects, which are more active learning methodologies, like they're part of the STEM movement. And the idea really is to play. So it's to build something cool and to program it, which is to give it instructions and to be inquisitive around it and make it come to life. And so what that does is it actually fires these neurons in your mind, which is different to a passive learning method, and you get to build something. And so it's an active learning method, and it really develops your cognitive ability, and that's what's exciting about it. And it's fun with our kids and even some of the adults. I remember my dad came to me and he's like, can you teach me how to do this? I want to do it again, you know. And it's so it's fun, and that fun element really gets kids excited.
You have a model, I think it's called Business in a Box.
Yeah.
How does that work?
Yeah, so for many years, we've been focusing very much on assisting schools in implementing these subjects, trying to partner with government, trying to bring this into the schools as an in-curriculum subject. And what got me thinking is the big problem that we have in Africa, and specifically in South Africa, is unemployment. And so entrepreneurship is something very exciting for me, being a founder and being an entrepreneur myself. So we thought that there's so many learners that leave our programs, and we kind of want to take the journey further with them. And we really believe entrepreneurship is the true way of actually creating businesses. So we were thinking of Business in a Box as more a market innovating concept. So how do we create a market with it? So the idea really is that anyone, like a teacher, a community caregiver, or a entrepreneur, can really come to us. We have this really new toolkit that we designed. It has some robots in it, a laptop, curriculum, a loaded LMS. We train them, and the idea is that they take this toolbox back to their schools, their communities, and they set up these innovation hubs or centers and really transform the community around them, and really start going to the people that are not part of the schooling system, so the non-consumers, and get them to become participants in this movement. And the whole idea is, how do we create that ecosystem where learning is becoming exciting and innovation is becoming exciting, and that the people that never had this opportunity in school and the students that are not part of the traditional system can become participants in the space.
You started in 2019. Something happened in 2020. I forget what it was now. How did demand change over time? Were there some people who you just knew immediately they're going to tell everybody, and there were some people who just didn't get it?
Yeah, so I told my co-founder, who's insanely risk averse, he's the opposite to me, and I told him, bro, I'm telling you, this was in 2019, right? If I go pitch to 100 schools, we will sign 20 schools and we'll be in business. Like, just trust me.
Yeah.
So that was the kind of plan. So we got a bit of investment, and 2020 Feb, we started off. Then COVID launched in
March.
in March, and it was an exciting 8-9 months in a sense that we were stuck at home. We couldn't go to market. And what was insanely scary is that schools were actually cutting budgets. No sports was allowed, no extracurricular was allowed. And so we thought this is probably the worst time to launch it. But what we did was we anyway created the product, focused on building it out. We had the entire 6 months of focus of where we could build the product. And I can't tell you how, but we did end up signing 20 schools at the end of the year, even during teacher retrenchments and not having these extracurricular clubs. And from there, we haven't looked back. 20 became 60, became 120, and currently we are about in 450 schools in the country.
Sure. So interesting, Rajesh. Thanks very much indeed. It's a great story. Really appreciate the fact that you were actually able to come in. Rajesh Busangeli is the CEO at Resolute Education.
The Money Show.
Investment School.
24 minutes now to 7 the time. Time for Investment School tonight. As always, you can put your questions too on 011 883 0702 021 446 0567 and voice notes on 072 702 1702. When you look at what's happening around the world, if you look at a record gold price and record prices, record indices in the US, the markets breaking records there, largely because of AI. Because we're also seeing different growth patterns in different places, we thought that it might be an important moment to have a conversation about why global diversification matters, particularly in today's market. Vincent Anthony Raja is the CEO and co-founder at Differential Capital. I've known him for a long time. He's happy to take your questions on 072 702 1702. Vincent, good evening. Thanks for coming in.
Good evening, Stephen, and thanks for having me.
I suppose the first question that you would have to look at is why you would need to diversify now would be about what's happening in the world. And we're seeing different things happen in different places. And even to the point of interest rate differentials between, say, the US and Europe.
Yeah, there's a lot of, I think, very important trends to take note of. I think interest rates are one very important driver. And let's just talk about it in the context of central banks and governments, potentially meddling into the affairs of the central banks themselves, potentially undermining the strength of their currencies. And so that's a major risk. So, if you look at what the US is potentially going to do is push down rates further. That's probably not the best thing for the inflation. So all those kind of risks should be considered. But if you take also a step back and think about the bigger macro trends in the US, that economy is being largely driven, at least the stock market anyway, largely driven by the AI theme, right? And whether it works or not, whether there's going to be a real productivity shift is one major theme which you need to consider. Europe has a very different set of problems. You've got an aging population, horrible fiscal situations. In simple terms, those governments have way too much debt and are not collecting enough revenues potentially. So you've got that, and you've got a destruction of their manufacturing base. So if one only has to look around South Africa, look at the cars that you see parked next to you. Probably 10 years ago, a good chance it was a German car. Now I'm probably quite confident that 1 in 3 is a Chinese car, at least the new ones anyway. So, and that's on that side. On the other side, you've got China, who's starting to take over the world's manufacturing chain, more than just, let's call it, simple goods, cars, far more advanced goods. And then on the other side, you've got the Southeast Asian economies, which are, there's interesting trends. And finally, back home in Africa, there's also material, trends around Africa, specifically around the commodity demand that the rest of the world seems to want. So those are the important and quite divergent, trends that one needs to consider. And I think we're probably going to go into a world where, let's call it, returns are also going to be quite divergent because of these themes that are not exactly correlated with each other,
So what that means then is that you need to have a little piece of the right action in the right place. And that's become more important than just throw your money into the US stock market.
Yeah. Unless you're very certain, I'm not, unless you're very certain that, investment A, or say now you have a view on Europe or you have a view on the US markets, unless you're very certain, and you might have an information advantage I certainly don't have, I would say it's important to diversify.
There's been a time when, for a very long period, markets were kind of moving, not quite in lockstep, but certainly together. We talk about the sort of end of the Cold War kind of boom. The whole world almost seemed to be growing. That seems to have changed. Now, that must have quite a lot of quite serious implications for how you sort of manage your portfolio now, because now you can't just take a sort of broad approach and it'll all go up.
Yeah, I think that's very important. I think the world where you could just pick some passive strategy where everything relied on one really major trend around the world, which was like, we went through 30 years where interest rates around the world were getting lower and lower and lower and lower. And we went into the GFC, and then afterwards all economies around the world, central banks also rallied together and pumped liquidity into the system together. And I think things really changed around the time, Trump's first time in power, where you could start to see real geopolitical tension pushing against, let's call it, the world coming together. And countries are really starting to diverge in terms of their own strategies, what they're trying to do, and what they think is best for their own populations. And I think that major change should really be considered carefully by investors. So yeah, you're spot on, Steve.
So you really do need to sort of think a little bit more carefully. So then you've got emerging markets. And we were talking about it earlier in the show, earlier this week, about sort of the phrase. We were talking about the phrase, not making the comment. Africa is the continent of the future, partly because it's the one place where populations are growing. But there are other places too. India and Indonesia, for example. These are places that you just cannot ignore in a way that maybe you could a few years ago.
Definitely. If I was to start with India, I think they've been delivering 6% GDP growth for the last 25 years. Their stock market is doing really well because over the last 6 or 7 years, they've started to liberalize the economy, reduce regulation somewhat, and that's really spurring their economy on. And you're starting to see the rise of the Indian consumer, the developing middle class. And the important point that you mentioned there, Steve, is about, a young population, a young labor force, which they have, which is very different to China and Europe for certain. So that is an economy that you can't ignore. And it's not something that you can easily invest in either, which probably makes it, interesting for South Africans to consider. Similarly, if one thinks about other Southeast Asian economies like Indonesia, like Malaysia, the Philippines, I think, there's economies like Bangladesh, Sri Lanka itself, which are also interesting to keep an eye on. And then you've got, Africa, which I think now, for the next few decades, more than ever, what drives Africa, bottom line, are two things: the commodity, abundance, as well as youthful, populations, a strong labor force. And I think that's going to be, ingredients to success in pockets around Africa, particularly countries that kind of get their policies right. And there are quite a few out there. If I am quite encouraged by, if one looks at the listing of Optasia this week, and you just read a bit about what's happening there in various countries, that's an awesome investment story. At least, its prospects are a different thing. I don't know, but certainly what they've managed to do is a clear example of how one can harness these populations which are starting to come out of poverty, emerging maybe just below middle class. But that trend, I think, will continue. And again, you've got a large continent that one simply can't ignore like you did for the last 20 or so years.
And many of these countries will have their own ShopRites and Capitex, and especially their Capitex. If you buy into their Capitex at the right moment, it'll deliver for you over the longer term.
Yeah, definitely. I think, if you look at South America, you have the story of Nubank, which, is again, let's call it a Capitec in South America, Brazil. So I think these emerging economies, and I have to exclude China out of that because I think they're more developed now. I think these emerging economies, let's call it the new set of emerging markets, have really, really interesting investment themes. And again, I think it's very interesting. It's worth a look. And that's geographical, Let's not forget there's asset classes, commodities. So there's this whole, the raft of things that one needs to consider because, again, I think that divergent theme applies equally across asset classes as it does, geographic regions. Yeah.
There's also, of course, issues around currency diversification. So, and I mean, some of the reliable comments that you could make, some of the sort of, foundational points are being swept away. And particularly one of those is dollar strength, that you would put your money into the dollar and that everything would be rated against the dollar. And that seems to now be changing. You would probably, I never thought I'd have an American ask me where they should put their money, but it's actually happened. And so what you're seeing is you need to sort of look at other currencies quite carefully.
Yep. And other currencies, and importantly, start really thinking about what drives the currency. At the heart of it is the real productivity of the economies that it represents. So if one thinks about like the yuan, the reality is as they produce more and more things for the world to buy, chances are you're going to have to settle in their currency. Dealing in dollars just is going to make less and less sense, just logically. Why would you, if it gets to a point, let's just extrapolate. If we bought all of our cars from China, why would they eventually want to have, rands to dollars to yuan? Probably not, And I think you're going to move to a world where, again, just that trend of China and also the weakening manufacturing base of Europe also means that, the euro itself probably also wanes a little bit as a currency in which you want to deal. So I just think you're going to have a more diverse currency basket underpinning productivity. And, the earlier comment that you started with, Steve, about interest rates around the world, because that also impacts currencies. And if you go into a world where, due to political interference or otherwise, you have to lower interest rates, demand for those currencies also drops. So those are things that we're also going to have to factor in. And again, diversification across geography, across currencies is something you have to think about a lot carefully. Yeah.
Does it also make investing more complicated? The fact that you suddenly can't really predict currencies and can't necessarily be sure what your correct currency allocation should be. Again, it comes back to 5 years ago. Oh, the dollar's going to weaken. I think people would have laughed at me.
Yeah, I think we are moving into a world where, again, because we're at this change in, regime change, it makes it difficult until we figure out what the new trends are going to be. And then it becomes a little bit easier afterwards. But I think we're at a major inflection point as far as world macroeconomics is concerned. And it makes it tricky, but also very interesting, I find. It's not the same story about, the dollar is a one-way trade, as it has been, for a long time. It's not that probability is zero, by the way. One shouldn't write off the US. If they pull off what their bet on AI is going to be, that point that I made about productivity being a key underpin of a currency, that could weigh in the dollar's favor too. But again, I think there's a lot more balance to that equation than there was, over the last 20 years, particularly from a South African perspective, because we've been so used to, the rand being punished one way, and yes, we still have, question marks around our own fiscal discipline. So in simple terms, that's just the government's balancing of the books. But again, I mentioned the point about commodities. And if you look at South Africa's history, a commodity cycle, there's nothing like a commodity cycle to give the rand a couple of years, maybe more, of at least parity or strength against the dollar. So that's something you need to watch.
We're speaking to Vincent Anthony Raja on Investment School tonight, the CEO and co-founder of Differential Capital. We talk about global diversification, why it matters in today's markets. Your questions for him, 011-883-0702, 021-446-0567, and voice notes, of course, on 072-702-1702. It's 11 minutes to 8.
The Money Show with Stephen Grootes is brought to you by Absa CIB, proud sponsor of the Absa Africa Financial Markets Index 2025.
The Money Show.
Investment School.
Vincent Anthony Raja, CEO and co-founder of Differential Capital. We're talking tonight why global diversification matters in today's markets. Your questions from voice notes probably best, 072-702-1702. You can call as well on 011-883-0702 and 021-446-0567. Vincent, underneath all of this, we haven't even mentioned it yet, is geopolitical risk. And if we look at what's happening with trade wars, the meeting that happened today between Trump and Xi, global politics probably having a bigger role in investment decisions than it ever has. And it's also, I would suggest, if you're a Canadian aluminium exporter, making investment decisions, some of them almost impossible.
Very important to bear in mind. Again, let's call it since the 80s, the fall of the Berlin Wall, Glasnost, the world trended in one direction, sort of accepting one sort of common idea amongst many, many countries. And in that you can even include China, But right now, countries are trying to do what's best for themselves. So this polarization is important, and it's exacerbated by countries' balance sheets that are not strong. So there's a very experienced hedge fund manager by the name of Ray Dalio, and he writes about these major cycles that happens. And the scary one is that, when countries get into points where they overlever it, and the US, one could argue, has high amounts of debt, Europe, etc. What happens next is a currency war, which, when you see interest rates dropping, that happens, but that can be followed by a hot war, kinetic war. And we can see pockets of that happening around the world, right? So I think those components, again, add further risk to the mix. So again, if you're an aluminium manufacturer in Canada, or, a copper smelter, somewhere in Africa or in China, I think the considerations for who your client base is going to be, all of that becomes more complex. And as an investor into these businesses, someone as simple as investing in a fruit business in the Western Cape, and where they, what's going to impact them, all of those become, add risks to the mix that weren't there before, certainly over the last, 10 years. So all of this, all of these factors make, investing a lot more complicated, again, because we're going through this inflection point.
Fine to be a gold producer or a platinum producer in South Africa, it would seem, because not everybody wants it. There's also the issue around what I suppose you would, if you had to sum it up, you would call sectoral diversification across borders. So you've got tech in the US, you've got manufacturing in Asia, you've got resources in Africa. All of those are going to be involved in the same supply chain. It's going to be designed in California, made in China with coltan from the DRC. You can be exposed to all of those things.
Yeah. And those are the sectors that probably have tailwinds. What about sectors that, are probably going to be wiped out by some of these productivity gains? So if there's certain things that I worry about, like, let's call it the industry of translation in a world where AI can do that really well. If you think about it, there's quite a few industries and sectors that are going to be very much at risk. And then you've got sectors where there's a lot of questions around, like, I think about this a lot. Like 5 years ago, the whole work from home trend was possibly going to destroy the office sector. But, it looks like everyone's back and no one's built a new office in a long time. So maybe there's, so again, there's these pockets of interesting sectors that I think, could also come alive despite all of these mega trends, So I think trying to think about, let's call it broadly, which sectors are going to benefit from them. I think the way you've characterized them is right. Your Chinese manufacturing, people exposed to that, the commodities, the AI is one, but then there's a myriad of subsectors which I think are important. One that I like to follow a lot in the US is the security, when I talk about IT security industry. That is going to become a much more complex world to be in. And I think those kind of services will become incredibly valuable, you know.
And I mean, whoever has them wins. So suddenly the value is massive. Yeah. And I mean, Putin said they tested a nuclear-powered torpedo today. So, I mean, that field is moving. There's also a correlation breakdown. So some assets, some things will move differently in the event of a crisis. Some things will move one way while everything else is moving the other way. You would need to find those things. You need to have some of them in your portfolio. You'll need to have something that's, I suppose, in a way, maybe a little bit defensive, if that's the right word.
Yeah, defensive is one aspect of looking at it. But let's just focus a little bit on correlation. What does it mean when we say two asset classes are correlated? It means that when one goes up, the other tends to follow it to some extent. And similarly, when one goes down, the other tends to go down as well. That's when we say two assets are highly correlated. So when you're trying to put together a portfolio, you can reduce your volatility of your portfolio and reduce the risk by ensuring you invest in assets that are not highly correlated with each other. Now, when you're only looking at two asset classes, it's kind of easy to do the math in your head. But once you start looking at 7 or 8 and across geographies, it makes things a lot more complicated. You can't do that. Even on a spreadsheet, it's kind of difficult.
And then for South Africans, for us here, what do you need to sort of do to get exposed to all of this and sort of avoid the risk? I mean, it's the obvious question, isn't it?
Yeah.
How do you avoid the risk? Invest safely.
So, Stephen, I came across a very cool tool on the internet. But I think it's the concept that I want to share with your listeners is there are tools that help you look at, let's call it the range of themes that we've discussed today. And I think most people kind of get a sense of what they are. So they're ETFs, that will give you exposure to gold, to commodities, to US tech, to European stocks, to Asian stocks, to Chinese manufacturing, right? But the question is, what proportion of your portfolio should you put into what? And that becomes kind of difficult, really difficult to do in your mind. And you can say, okay, maybe I put 5% here, but again, it's those thumb suck rules can also be dangerous. So what a useful tool that I found is Visual Portfolio, and what it does is it's a simple tool that says if you've got a range of asset classes that you potentially want to invest in, it'll tell you for a desired level of return. And again, it's based on history, what your portfolio mix should roughly look like. And it's those kind of tools online, perhaps even a good financial advisor can help you with, because, I think the world is going to be more complex from an investing perspective than it was before. And diversifying is not going to be as simple as it was before.
And so you need humans to do it, not AI.
Yeah. Look, that's a very good point you make, because, AI depends on historical data.
Yeah.
And you're going to have to consider a lot more. So, things that could have been correlated in the past might not be as correlated going into the future.
It's about the insight, isn't it? Vincent
100%.
Anthony Raja, thank you so much for coming in. Really appreciate that. The CEO and co-founder at Differential Capital.
The Money Show with Stephen Grootes is brought to you by ABSA CIB, proud sponsor of the ABSA Africa Financial Markets Index 2025.
Well, U.S. markets still, I think, digesting everything that's come from Trump and Xi and interest rates today. The Dow Jones is up 0.22%. The Nasdaq down 0.97%. The S&P 500 down 0.44%. Aubrey is next. We'll be with you tomorrow. Good evening. It's 8 o'clock.